welcome to the latest episode of the Structured Products Insights podcast. I'm here with my co-host Tiago. Tiago, start off. How are you doing? How's your day going?
Very good, very good. Sunny in London, so I think we're all very, very happy. Let's see if it continues like this.
Yeah, so hopefully it's also sunny where our guest is from today. Today we have Joseph Kheng. Nice to meet you. Welcome to the podcast.
Hi, thank you very much for having me. It is extremely sunny here in Bangkok, 35 degrees. So,
Nice.
Pretty hot one today.
We need that. We definitely need that.
Look, we have a pleasure to have Joe here, especially because again, he's based in APAC. He works with a lot of brokers and advisors. I would say on expat community, but across Asia, Middle East, and so on. And as a director at Access Notes, as the name says, he works with notes, especially structured notes. So, Joe, we really wanted to have you here, have this conversation with us, to have an honest conversation, especially how advisors use structured products and how they don't use. So if we start about, what are the biggest challenge for independent advisors using structured notes, especially in balancing between, growth and having, investing on mutual funds and private equity versus the capital protection?
Yeah, I think the biggest thing for advisors to firstly understand is how structured notes work and the kind of different versions they can build and use, and how those kind of fit into the scenarios of the clients and the scenarios' needs and wants. So I could have a client come to me who wants monthly income. They've just sold a business, for example. They want to protect that capital and they want it to generate them income to essentially retire on. So that's a straightforward kind of case. We have a monthly income note which has capital protection built in, so they just get paid essentially on a monthly basis, kind of like a retirement salary essentially, or retirement income. And then we've got the other side of things where people aren't necessarily interested in income whatsoever. They just want to kind of put some cash somewhere, keep it there, and then it'll eventually mature in years go by. But I think the biggest issue for advisors is they don't necessarily understand the difference between the 2, 3, 4 different kinds of builds they could possibly use, and then also the blend of those builds within a structured note portfolio. I think is really important for them to understand as well. So the biggest thing that I always say to advisors is when they've got, let's say, a client who's got 100 grand, for example, the kind of a typical sized account, and they want to do 30% into structured notes, let's say, they then go, well, I'm going to use this one note. And I'm like, well, why would you just use one? Why? You can use 3 different notes within that 30%, and you've then diversified within the structured note element of the portfolio. And I think that's the biggest challenge, is just understanding how to structure a portfolio with structured notes is something that goes over everyone's head. And it's difficult because it's not necessarily it's not a one-size-fits-all solution, right? So it's different for every single client, and just kind of understanding those needs and wants and then building a portfolio around that is something that they massively struggle with from what I kind of see.
Yeah, are you seeing that the use of structured notes is kind of helping to alleviate the shortcomings of traditional portfolios and kind of push those forward a lot better?
I think there's a lot of advisors out there that use the structured notes, especially the income elements of it, to essentially offset the charges within the policy. And that's definitely one kind of use case for them, which I don't think that wouldn't be my first thought of what to use it for. but that's what people use it for. Like, okay, we're only going to put 5% in a structured note because that will give us enough income to offset the charges. And it's kind of like, well, then you're just wasting 5% of the portfolio, because if all you're doing is trying to get to net zero, what's the point in using it at all? You might as well really either commit to it or don't commit to it at all. There's kind of not really many issues in terms of doing it. So I think that's one thing. And on the charges side of things, I think it's quite important to understand as well that you can kind of set the charges on a structured note however you like. I know they're kind of this unspoken thing that no one really talks about. Like, someone's getting paid somewhere along the line. It's a financial product. I hate to break it to everyone, but like, nothing's free. And I've had advisors come to me and say, I don't use structured note because there's commissions built in, and I don't think it's right for my client to have them because there's commissions built in. And my objection is always, well, if you're going to put 25% of a portfolio or whatever it is into structured notes, and on that 25% you're earning X amount, and you're likely to probably earn that every year to 2 years based on auto call frequencies, or whatever it might be, then just drop your annual management charge down to take that into consideration. If you're that fee conscious, you can easily reverse engineer that maths and figure it out that way. So instead of it being a situation where you're using structured notes to cover charges, you can use structured notes and reduce charges, which is something that no one really looks into too much.
That's a very interesting one, Joe, because I think the let's say the most advanced private banks, when using structured notes, they actually made that difference. They have their brokerage and advisory notes, which they have both available. So you kind of know, the price is different, but that's you decide what type of fee you want the client to have. Is it upfront when you buy the product? Usually that works when the portfolios are lower, right? Because if you have a small portfolio, you really can't afford having a management fee, right? And then but it's the advisor and the client together that make that decision.
It's exactly that. And I think there's a lot of advisors out there that I know, because I would kind of categorize the advisors that use structured notes as rightly or wrongly more successful, as it were. They tend to have a higher revenue, they get more referrals, they get more top-ups, more larger average size case as well. Average size accounts are a lot higher. And hardly any of them charge a management fee. There's none on there. So when an advisor comes in who, let's say, doesn't use structured notes and comes in and finds that client and then looks at their portfolio in an attempt to try and kind of steal them away and bring them onto their side, they look at it and they go, well, I don't understand how structured notes work, so I can't sell the same thing as well, but also he's not charging him anything. So I can't take the client either because I'm not going to make any money from it. So it kind of creates a bulletproof book in a way, where if you don't understand structured notes, you can't take that client off them because they love the notes. They don't want to leave them behind. They don't want to stop using them. So yeah.
Something that impacts, right, the fees, of course, is having the money in cash, right? At the moment, there's been big percentage of cash allocation right across the world, with a lot of people not knowing what to do, especially now with the AI, the technology firms coming down quite heavily. How much is this a threat in terms of client fear, and how much is this cash can drag potential long-term growth?
Well, I think it can have a massive effect, right? The longer you're out the markets, I mean, everyone always says, every advisor that doesn't use structured notes always says time in versus timing. So, and then you get to that situation where, okay, well, now we're probably not even using the time in version of that. So now we're just doing nothing. So I think the idea behind this is, which is something that I've said to many advisors over the last few months especially, is if you don't think a developed index-linked structured note with pretty deep barriers, if you don't think that the markets are going to stay within those barriers, so essentially you're saying it's not going to work, okay? So if you don't believe a structured note is going to work with deep barriers and developed markets as the underlying assets, then you're essentially banking on a global financial crisis in reality of things. And if you're doing that, then all of your clients should be in cash now, because that's the counter to it. So there's one of those situations where you're kind of saying, I don't think that these work, but I'm not going to do the thing that I would do if it doesn't work. So you get to that situation where you're going to have accounts out there which are going to get hit by volatility, and they always will do. And I'm not saying you should go 100% into structured notes. Everyone's going to feel volatility at some point in the next year to 18 months, in my opinion, based on what's going on in the markets and how overvalued and how high everything is at the moment. So it's just a case of how you want to play that. And I personally don't think those conversations are happening with clients as frequently as they should be. I don't think there is necessarily a plan in place for a lot of clients out there. And I think one of the easiest plans to implement is structured notes with developed markets and deep barriers. I think that's the easiest way to kind of ride out any volatility over the next 18 months.
So we talked about a few topics, right? From volatility, cash, the education issues. From all of this, what do you think it's the biggest pain point for advisors using structured products?
I think the biggest pain point is not understanding the pricing, to be honest with you. I think there's a lot of advisors that look at, let's say, a structured note that's developed where the underlying assets are individual stocks. Okay, versus the structured note where the underlying assets are developed markets. There's a lot of time people look at them and go, no, these are like, they look at an individual stock basket and it's returning 15, 20% or whatever it might be per annum. And then a developed market one they look at and it's maybe returning between 7 and 9%. And there's always the question of, well, why would I use that one versus this one? And it's just the whole understanding of the risk versus reward of the two, or of notes in general, is what advisors really don't get. So when you look at developed markets quarterly income note, for example, let's say if you've got a European barrier at 60%, okay? So that means for that not to work and for the client to lose money, those underlying assets would have had to be down 40% over a 5 or 6 year period or whatever the term is. Tell me an occasion where that's happened in the last 25 years. So like the only occasion where it's happened recently is the Hang Seng, which it happened over COVID. There was one of the biggest property market crashes the world's ever seen. There was geopolitical tensions with Taiwan, Hong Kong, and then also COVID-19, which was the biggest pandemic we've seen. So it's like, okay, yeah, kind of understandable as to how that happened. That's not a structured note problem, that's a Hang Seng problem. And I think that's one of the biggest things that people don't understand is when you look at the S&P 500, Euro Stoxx 50, the FTSE 100, the Swiss markets, they haven't had a period of negative 40% over a kind of a 6-year run since the early 90s, basically.
Yeah.
So I think that's one of the things that people don't really understand is the risk versus reward. The risk is relatively low on developed markets for the reward you get.
For index, right? For index linked with the diversified equity indices, right? Because if you go to single stocks, that's slightly different.
Definitely, yeah. And I think they're very popular in especially India, from my experience, and also in the UAE, are single stock notes. So when you're comparing kind of apples for apples, it's impossible because apples for apples is not the same thing. It's the same as comparing like mutual funds and the underlying assets within them. They're often completely different if you're getting wildly different returns. They're not invested in the same thing, but because no one really takes the time or care to look into the underlying assets within a structured note, the historical pricing of them, and then also the back testing of them, it's something that gets completely forgotten about. And they just kind of go, not really worth it for 8% because my client could potentially lose 40%. If your client were to lose 40%, we've experienced some massive crashes in the markets, which over a 6-year period as well. So it's like, there's a lot of things have to go really, really wrong for the structured note not to work, basically.
I mean, earlier you were saying how a lot of advisors are using structured notes just to offset fees in a model portfolio. What do you think is the best way? What do you think is the best way of structuring a portfolio using structured notes? The opposite of just using for fees. How would you do it in a kind of a modern portfolio? What's your
So the way that the reason why I think they're such a good product for financial advisors is because I think the quarterly income note especially is almost the perfect product for a financial advisor. And I don't say that lightly, but I've seen advisors develop their whole business around a quarterly income note. There's 2 ways of doing it. One is you just use a quarterly income note. 3 months' time, you can call your client, and so long as the markets haven't dropped by 20-odd%, you're gonna have a coupon. It's a good news story almost instantly to tell a client. The other way to do it is to basically buy 3 quarterly income notes over a 3-month period. So you're essentially creating monthly coupons. In that case, you've then got a client who's receiving monthly coupons into his account, and you can call him whenever you want or call her whenever you want with a good news story, which you just don't get with mutual funds or ETFs. It doesn't exist. What's good about it is you're building that relationship constantly because you're calling them and telling them. You can even tell them ahead of time. I could call them now and say, on Friday, you're going to have a deposit of X amount into your account because markets, unless they drop 15% in the next, or whatever the gap is, unless they drop that in the next 4 days, you're going to receive this coupon. And the same again when it comes to auto calls or maturities. To be able to say, okay, this has worked exactly as I told you it would, and it's going to come in there. The trust that it builds is like no other in comparison to a mutual fund. So if you've got a mutual fund and the client, because every client asks, what am I expected to get back? What's my returns? If you say 8% a year is the average, okay? If we have anything less than 8% a year, you've let the client down. And especially if we have a negative, if we're minus 10% at the end of this year on the S&P 500 and your client's essentially 18% out from what you told them, that's not how to win a client or build trust. Whereas in that situation, if we are 10% down on most developed markets, your client's still going to be around 8% up because he will have got all of his coupons throughout the year. So it's one of those situations where I think it's absolutely perfect to build trust with the client, constant touch points and communication with them. Essentially build a calendar around the structured notes life cycle and be able to communicate that with the client on a regular basis.
Joe, I think it's very important, right? It's those positive and the income that really generates a lot of vibe with the advisors. But how do you keep clients invested, especially when there is a downturn, right? How do you communicate effectively?
In terms of if there's a downturn in the markets and the structured note is still all above the coupon barrier and everything's above the coupon barrier, that's the easiest way to win referrals and to win new business out there, because you're outperforming the markets quite considerably. And this is the other thing that advisors don't do. If you've got a client who has a structured note and we're in a down period within the markets, but you're still getting the coupons and it's still paying out, that should be something that should be celebrated. You're beating the markets by definition. It's like this is something that you should call your clients and say, look, to explain the situation, be completely open and honest with them and say, look, at the moment we've got 4 underlying assets within this structured note. 3 of them are down, 4 of them are down, or whatever from when we first purchased it. But you're on this investment still, whatever, 4 or 5% up or whatever it might be at that point. That's a really powerful conversation to have with clients, because you're showing that your plan that you've designed and executed is working for them. And a lot of people or a lot of advisors kind of don't do that. They just kind of send another one over to them and go, oh, here's another note. Are you interested? And it's like, no, explain to them what you've done. Explain how it's worked and how you've essentially beaten the markets by this plan that you've drawn out. And I just don't think it's done anywhere near enough.
I mean, it sounds like you have a very kind of pointed way of using structured products within a portfolio, but are there kind of individual objectives that you're trying to hit when you're structuring a portfolio for a client using structured notes?
My number one thing is don't lose money. That's the same as Warren Buffett, and that's one half of his investment principles, right? It's just don't lose money. The effect of I've seen it. Negative compounding in an account is one of the worst things that can happen. So working for platforms previously and life providers as well, and seeing kind of how structured notes work in those instances, is as soon as there's more clients leave you as a broker during bear markets, okay? If your client's going to leave you because on a performance reason, it will be because markets are down. Okay. No one leaves you when markets are 20% up and you only made them 15. That's not a case where a client turns around and goes, oh, you only made me 15 when I could have got 20. They're happy with 15%. But if they lose 15%, even if that's just the markets, there's more chance they leave and go somewhere else because you haven't prevented them from losing money. No one wants to wake up in the morning and see if they only check their account, because people don't check their accounts every day. I hate to break this to advisors as well. Most clients actually don't care that much. They don't look at their accounts because I've seen the stats, I've seen the ITs. Yeah, exactly. They only look at their markets when essentially Donald Trump says something. And they see it on the news and they see, oh, it's tanked the NASDAQ or it's tanked whatever. Then they log in and check and go, why didn't you do anything about this? Then the advisors are kind of stuck with the tail between their legs and go, well, I didn't know he was going to release tariffs on the whole world. But every single client from last year who would have owned structured notes, that didn't affect them. Those 2-3 weeks of mass volatility during the markets, it didn't affect them whatsoever. Whole kind of philosophy around using structured notes is just to get consistent compound growth. I think it's the easiest way to do it without adding a huge risk on there, especially if you diversify within the structured notes itself. If you're buying multiple structured notes across the course of a year, it's highly unlikely for all of them to fail, basically.
Yeah. Joe, something right, I know that you focus a lot on structured notes, but of course your clients do not invest only on structured notes, right? It's a very small part of their allocation. How do you have the conversation how structured notes compare with mutual funds, private equity, right?
I think the beautiful thing about money is there's a million different ways to make it, right? There's so many different combinations of a portfolio that's going to work. So I kind of focus on the structured note element of it and say, whatever percentage you want to use of your portfolio with structured notes, I can help you out with that percentage. If you want to look at mutual funds for the other 70% or 80% of the portfolio, then to be honest with you, most advisors know more about mutual funds than I do. So you figure out which ones you like and which ones you want to use, and you go for it. And I've got no issues with it whatsoever. I just think that structured notes should have some sort of consideration within a modern portfolio. I don't think they should be completely ignored. I think that's a very naive thing to do. When you look at their track record and their performance and their history, every single note that Excess Notes distribute comes with backtesting, and it's got 100% success rate over the last 12 years. We literally don't issue a note without 100% backtesting. And everyone kind of looks at that and goes, how did you manage that? And like, well, just look at the markets. It's pretty straightforward if you look at the markets over the last 12 years. The only real developed indice that would affect 100% backtesting is essentially the Hang Seng. Every other developed indice, you'd have a 100% record on a kind of 20% coupon, 40% European barrier, or 80-60, whichever way around you want to do it. It would work 100% of the time over the last 12 years at least. I mean, if we go further back, it would probably work over the last 25 years. But and I think that's just the reality of the situation. It's like if you're looking to use a kind of a government bond or treasury bills or something along those sort of lines, or even fixed term deposits from banks, which come with obviously very little risk, I would argue, well, why would you not get a little bit more of a return and generate a revenue for yourself as an advisor versus using annuities or whatever it might be? Because I think that kind of fixed income element of it is very important to have in a portfolio. We all know it is, but it's just kind of ignored. And especially, I mean, it's probably a bit different in Europe, but over here in Asia, we have lots of spicy fixed income products that exist in Asia. So, I mean, they're not necessarily licensed. They don't necessarily have ISIN numbers, and they're kind of one of those things that obviously I wouldn't touch with a barge pole, but some advisors look at them and consider them seriously. And I'm kind of like, why would, when you've got this issued by, you know, an A-rated bank with developed markets, a household name, you'd go for the product that no one's ever heard of because they're paying you more and they've got a nice story. And it's kind of like that you can't have both, really. If you want something which has a little bit of risk with a bit of upside, but in reality has worked the vast majority of the time over the last couple of decades, then I think the structured notes the product for you. Especially as it generates you an income as well at the same time. I think it's a no-brainer.
Yeah, no, I think I agree. I think it's very easy. We're on a structured products podcast. So there's three people here that are in this.
Yeah, we're very biased.
Yeah, we're quite biased about the industry, right? But if I could ask you just to play devil's advocate really quickly,
yeah,
and kind of give me, you know, why are some financial advisors hesitant to use structured products from that kind of outset risk, other side of the boat kind of look? I
think it's just the perception of them on. There's two reasons for it. Number one, they're very much used by one brokerage in the IF on the offshore space. We're not going to name them, but I think we could guess who they are. But they were used very, very kind of a lot. And I think the structure and the fees that were used with them were slightly abused, to be honest with you, on the back end. And I think that's what gained them a negative perception in this space. Also, there was a few stock-based notes that were released over COVID, which didn't really work. So I think a lot of kind of advisors that don't necessarily use structured notes a lot saw that and were put off by them and haven't kind of taken the time to look into more index-linked notes. And I think the other thing is people like to focus on the negatives, right? So if you look at the structured note, one of the first things advisors that don't really use them a lot ask is, what's the protection barrier? How does the protection side of it work? And as soon as they kind of look at that and go, oh, my client could lose 40%. Yeah, they could, but that would require the markets falling 40%. So it's the same as like if I said to you, oh, that mutual fund could lose you 50% if all of the underlying assets fell 50%. It's the same situation. And my argument would be, well, just buy into that underlying asset. If there was a situation where you lost 40% on a structured note, if you bought that underlying asset that probably dropped that much, you could then make on the recovery if you just bought it directly. We've seen it with the Hang Seng, right? If you would have lost 40% on a Hang Seng note and then just bought directly into the Hang Seng, or bought an ETF that tracked the Hang Seng, you'd be back to where you were, or if not in profit. Yeah. So I think it's mainly that. It's just focusing on the negative side of things and just going, okay, well, this is the worst case scenario. And yeah, it doesn't look great, right? If the worst case scenario is you could lose 40-odd%. But then that's the same as I could buy a house. And if something went next door, or there was an earthquake or a flood or whatever, that's the worst case scenario. So it's a similar situation in that sense. But I think that is it. Just focusing on the negatives too much, I think, is the main thing.
So let's try to break these down, right? For new advisors, people trying to explore this, or trying to Google what the structured product is, they probably will come to this video. So what are the three big benefits that you see using structured notes, and what are the three things that people should take attention to when it comes to risk?
I think the first thing is it's very easy. They're very flexible, even though they're called structured. I think they're very flexible, and I think that's a very important thing for people to understand, is you don't need to just buy one structured note per client. You can build a very diverse portfolio by buying multiple notes in one account, essentially. And I think that's very important for people to understand from the start, is when they look at them and go, oh, this is very much set in stone, there's a set criteria, and they're kind of stuck with it. I think you can create them in quite a flexible way, in my opinion, or create a portfolio in a flexible way. I think the other thing is just to understand how they work, from kind of not just looking at the numbers and not just looking at the kind of the on a fact sheet or a term sheet. So the way that I describe it is essentially, what the deal is what we're doing here is the issuing bank is willing to pay you money in terms of a coupon or a maturity or whatever it might be. They're willing to pay you a coupon, let's say it's a quarterly income note. They're willing to pay you a coupon every 3 months, so long as these markets or these underlying assets stay within this boundary. And that boundary is negative whatever to infinite up. So that's in a nutshell how simple they are. Is if X happens, X being they stay above this amount, you get Y being the coupon. Okay? And that's in a nutshell what they are. People focus so much, as we just said, on the European barrier and the worst case scenario. But in reality it is the bank has, I mean, I'm oversimplifying this massively, and you'll know this a lot more in detail than I do. But essentially the bank says, we're willing to pay you this much so long as these underlying assets stay within these parameters. Is essentially what's happening, right? It's a lot more complicated and mathematical than that. But that's
ultimately the investor is selling volatility. He's selling, as long as volatility doesn't pick up and crashes, give me my premium. So they're actually doing an insurance, which is, I think, actually quite cool.
And I think that's the thing as well, is everyone has this kind of big bad hate for banks, right? That's the other thing, where it's kind of, there's like, because in my mind I'm like, why would you rather work with an unknown kind of loan note company over JP Morgan? Like, why would you ever even consider not using the JP Morgan when you've got those two options, right? And people kind of have this thing in their mind where they're like, oh, we don't like banks, they're evil, they steal from us. Like, well, they're willing to pay you here. Like, this is one of the easiest ways to kind of win the banking system, in my opinion, or to definitely profit from it in a way, is they're willing to essentially pay you to just hold your money so long as the markets don't adversely drop, is essentially the situation. And if you look over the history of time, how many occasions has this happened? Very few. I do have a graph somewhere. I'm not going to dig it out now, but essentially is through the 90s with the lost decade in Japan, the dot-com bubble. But if you even look at 2008, none of the markets, well, I say none, I'm sure there probably is some, but the S&P 500, for example, recovered back to its pre-crash level within 5.5 years. You would have got an auto call on a structured note if you'd have bought it the day before the '08 crash. So it's like, that's the worst financial kind of event that I've lived through. And it's like, well, if it managed to withstand that, and then obviously all of the kind of different regulations and things that have been put in place since 2008 to prevent the same thing from essentially happening, it's a pretty good bet, in my opinion. But yeah, what are your thoughts? How do you kind of see it being kind of misinterpreted, I guess, is probably the...
I think ultimately one is the fees, which we talk, and second is the lack of understanding of the risk they are assuming, right? Because when you're buying a structured product, right, you're especially on the income notes, right, which is where you focus mostly, and it's it's what the Asian market is. People are selling volatility, which means that they have this very, very high probability to get their coupons, to get their capital back, and get that participation. And what they are adding is let's say downside risk. But when there will be a big event, they will lose a lot of capital. I think I did the statistics the last I think did 20 year statistics. And yeah, it's 2% of those products do actually lose capital, considerable one, around 50%, but 98% of the products give participation. So in average, as long as you have a diversified portfolio, it does work. But of course, you need to make sure that you have a diversified and it's not one note. Especially you don't invest always on the same note. I found out.
Yeah, completely agree.
Because you invest, let's say, on, especially for the, let's say, UK offshore, right? They invest FTSE 100 and then FTSE 100 and then FTSE 100 and then, FTSE 100 comes down. It's not been happening, right? But it comes down and for a certain period you don't get your coupons, or you might see a potential loss. So I think that's an important point.
So that's what we do. We do that. We kind of help advisors with that, basically. So what we'll do is release 2 versions every month, 2 quarterly income notes a month. One will be with slightly more volatile underlying assets, Italy, for example, or Japan at the moment, which is obviously 50% up in the last year. So like we will release one with those assets, and then one with I don't want to say the word safer, but one with less volatile assets, like the S&P 500, for example. Although you could argue whether that's less volatile or not, but larger, let's say, larger markets. So we kind of do that, but then also within those 2 kinds of notes, we mix the assets each month as well. So if you wanted to just buy structured notes on a monthly basis, we're doing the diversifying for you. So we're taking that kind of question out of the equation for you, because each time you purchase it, you're going to get slightly different underlying assets. And then let's say if you were doing it over a 3-month period, for example, you're going to have a good mix of underlying assets there within the overall portfolio.
That's very interesting, right? You focus mainly on equity indices, right? Which are by definition already, or they should be diversified, unless Yeah. Okay. That's very interesting.
Yeah, I think again it's that case of just simplifying the product, right? So this is the other issue that we have with a lot of advisors, and then if it's complicated for advisors, it's going to be even more complicated for clients. So I think a lot of the clients, if you wanted to take a mix of different ETFs or kind of more thematic industry-linked mutual funds or whatever, and use those as the underlying assets, they make a lot of sense to you and I. And let's say if you wanted to do one based on like an ETF or an index that's linked to banks or whatever it might be, it makes a lot of sense for us. But then trying to explain that extra layer of complication to a client, it gets lost even more, because we're struggling to get advisors to understand them. Some clients on the end, just trying to keep it as simple as possible, basically, which is why we use the indexes. But so long as it works in the back testing, then it's kind of one of those situations. We could definitely get more returns, don't get me wrong, if you used kind of different indexes which weren't necessarily equity linked in the same way.
I think you were talking earlier about how structured products are great for client relationships, for new clients coming in. You get that kind of 1 monthly, 3 monthly conversation with them. How are you feeling it with kind of cautious clients or clients that are coming back into the market? Is it something you're offering to people that are kind of maybe been out for 4 or 5 years due to volatility, due to loss, and coming back in? How are you pushing through that way?
That's a good question.
Very good at what I do.
By the nature of that sort of client, right, they'll be cautious. So if they've not been invested for the last few years and they're coming back into it, they're going to be cautious. So I would focus on the side of just the back testing and how well they've worked over the years and how it's a good option for them. Also, there's obviously the option of 100% capital protected notes, which also don't get talked about very much. We're launching this week a fully 100% capital protected note, because we've seen, for that sort of instance, advisors especially who are kind of new to structured notes are like, well, how do I get a zero risk version? And like, okay, you get a zero risk in terms of the downside, but you're not necessarily going to get the upside. So it's kind of one of those where you're more likely to do better on it, in my opinion, on a quarterly income note, but at the same time, yeah, you might get an auto call in a couple of years, but the client's not going to see anything for 2 years. So you kind of balance, it's that balancing act where in that sort of instance, I would probably say to the client, okay, let's do 50% into a 100% capital protected note and 50% into a quarterly income note. You'll probably find once they've got 3 or 4 coupons come into their account, they'll go, why did we use that other one? Why didn't we have more of those? So because that's the situation that we've seen with a lot. I was with an advisor a few months ago in a bar having a beer, and he loves structured notes, which is why I work with him. But he sent out an email to his clients basically saying, these are the available notes at the moment. This client's bought multiple notes over the years because this is what's available. His reply was, which bank details do I send my money to from my account because I want to buy 20,000 of this note? And it's like that's how easy it was. It was a WhatsApp message. It's like when clients understand them, and it was basically, I want that quarterly income note from X bank, or it was basically, I want that one. Where do I send the money? And he just, as we were having a beer, he turned around, showed me his phone, and I was like, oh, this is how easy it is. This is how easy it is.
So we're almost running out of time. So I do want we do have a couple of questions for you here. So
go for it.
One is, what might advisors that are not using structured notes, what are they missing when not using them?
I think structure's the biggest thing. I mean, I know it's in the name, it's structured notes, but structure's the biggest thing. You can organize your whole calendar and whole kind of meetings and touch points with all of your advisors around structured notes. There's so many good systems out there as well, which can build this all for you. So you know if you've got maturities this month, also just projections of just being able to see what your revenue stream is and revenue cycle is, and essentially a cash flow analysis into your client's account. It's absolutely priceless if you're looking to figure out how to work, especially as to operate as a business. So I think one of the things that, and this might blow your mind being from Europe, but a lot of advisors over here have no idea how much they earn on each account. They have no idea. They don't know how the trails work. They don't know when the annual management fees are coming out, whether they're quarterly or whether they're getting paid up front for fees or mutual funds or whatever. They have no idea a lot of the time. Whereas it's very easy to structure a business around structured notes, because you can say, okay, we've got X amount in coupons coming in this month. 20% of those clients are going to take that money out and use it as income. The other 80% needs to be reinvested. To do that, I'll set up a Zoom call or sit down with them, and it just naturally works in that way, because from the client's perception as well. If we play the two alternatives outright, you've got one who's 100% invested in ETFs and mutual funds. You speak to them once every 3 months and just go, yeah, you're still invested. There's no real kind of feedback to give other than this is how the mutual fund has done. There's no reinvestments to talk about. And there's no kind of balancing to talk about because it's a managed mutual fund. It's all done for you. Yeah. Whereas in this case, if you've got a coupon that comes in and it needs to be reinvested, whether it even gets reinvested into a mutual fund or into another structured note, it's a conversation that you can have with the client. And I think if you committed to it, even with one client, I guarantee the percentage that client uses structured notes would increase if you use those regular touch points and spoke to them and said, okay, we've got $2,000 or whatever it is as a coupon that's just come into your account. We're going to reinvest that into the mutual funds until we've kind of got enough cash or whatever, until we want to go into the next structured note or until there's a next good opportunity. And often you'll find the client, like in that story I just told, the client will go, well, why are we even reinvesting it back into the mutual fund? Why don't we take some money out of the mutual fund and put it into the structured note? Even if the mutual fund's outperforming the structured note, which is often the case, they'll still want to use the structured note because they like the fact that it works on a regular basis and they like the fact that it's something tangible. So the other
behavioral, right?
Yeah, exactly.
Really behavioral, right?
And I think
he has this good news.
Yeah, it's a good news story that you can share with them. And the other thing is once I've worked for platforms, right? So I've seen a lot of accounts. I've seen a lot of them. And whenever you look at an account and you go on the cash transaction history or the cash history, there's never any positives to it. It's just trading fee here, management fee here, custodian fee here, a quarterly fee here, whatever it is. And it's just red, the whole way down. To actually have an income stream going into an account, which especially if it is larger than the outgoings, is a massive mental boost for a client when they look at their account. And they look at it and go, okay, he's doing something here. It's a tangible value that they're seeing versus 10% up on a mutual fund or whatever. that could then tomorrow be only 5% up, and they're like, they don't see that real money that's there in terms of like, it's like kind of like a computer game in a way where you bank your points or whatever it might, you get a checkpoint, and that's kind of how I see the coupons and maturities of a structured note. They're like checkpoints. You're just like, okay, banked, that one's done. We reinvest, we go into the next one, banked, that's done, and then you go to the next one, and you can see the portfolio grow over time a lot more clearly than you can do with a 100% mutual fund or ETF portfolio.
Cool. So, Joe, it's been wonderful having you on. Some really interesting conversations, really interesting questions and answers. I'm sure we'll be having another discussion in the future. Anything else you want to say before we wrap it up?
No, just thank you very much for having me. It's been an absolute pleasure. It was a delight to come across Tiago's LinkedIn and see structured note related memes. That's something I never thought I'd see.
Unfortunately, some people understand it, some people understand it. My wife doesn't, but at least some people have fun with it.
Yeah, no, as soon as I first saw them, I was like, God, this is my guy. Found him. No, love it. It's good stuff. Thank you very much, guys.
Thank you, Joe.
Okay.
Cheers.